Good afternoon, everyone. Thank you all for joining First Metro Securities and ATRAM's webinar. Our current situation is very fluid, and investors need all the information they can get to make better decisions. The goal of this afternoon's webinar is to share ATR Asset Management's perspectives on the equities market. Here is your host, First Metro Securities' very own Ms. Vanessa Galvez.
Hello, good afternoon, and welcome to a very special webinar in collaboration with our FundSmart partner, ATR Asset Management, or who we fondly call ATRAM. My name is Vanessa Galvez from First Metro Sec, and I, including the rest of the First Metro Sec and ATRAM teams, hope you find that what we have in store for you today beneficial for whatever purpose it may serve. We are all aware of the recent events that have significantly shaped the market. And I'm sure many of you are still somehow lost or need a bit more clarity on the direction of our economy. Many of you may also be looking for guidance so as to be able to navigate the market amidst this COVID-19 crisis. That's why we are here today with ATRAM, because we believe that it is a relevant time for you to hear directly from our fund managers about how your investment interfunds are positioned during this situation. Before we hand over the mic to our speaker, I would like to announce that we will be having the Q&A towards the end of the session, together with our very own research associate, Royce Aguilar. If you would like to ask a question anonymously, you may do so by choosing that option in the Q&A section. We will get to the questions at the end of the discussion. Also, I'd like to let you know that this webinar will be recorded and will be posted on the First Metro Sec YouTube channel. As we wait for all the other attendees to start settling in, please let me take this opportunity to invite you to be part of the First Metro Sec Facebook family. If you're not yet a member, just type in www.facebook.com/groups/FirstMetroSec, or you can also search First Metro Sec official community on Facebook. Please also don't forget to like and follow the official Facebook page of ATR Asset Management to get their latest updates. Head over to www.facebook.com/ATR Asset Management. As we start with the discussion proper, please allow me to introduce our speaker for this afternoon. Mr. Jun Tarrobago has 26 years of experience in the capital markets, with stints in investment research and portfolio management. Before joining ATRAM, Jun was the Assistant Vice President and Equities Fund Manager of ING Investment Management Philippines. Before that, he was a fund manager at Sun Life Asset Management. Jun also worked earlier in his career as a research analyst at Amstel Securities, Vickers Ballas, and Philippine Equity Partners, previously Merrill Lynch, Philippines. He obtained a Bachelor of Science degree in Management of Financial Institutions from De La Salle University. And now, without further ado, to give an equities outlook with the topic COVID-19 and ATRAM funds strategies, our main guy for this afternoon, ATRAM's Head of Equities, Mr. Jun Tarrobago. Jun?
Thank you very much. I hope everyone, well, first of all, good afternoon, everyone, and I hope everyone is staying healthy and safe. And yeah, well, this is a very timely discussion to have, I guess, given all the uncertainty in the market and how the markets have gone up and down. Up recently, over the past few days, the market has been actually up by about 20% already. So that's one of the things we're going to be talking about this afternoon. So let's set the stage first. Let's look at what has actually happened. And what has happened is the COVID-19 pandemic has the fear on the pandemic has mutated into concerns of a first half economic recession, which has shoved risk assets into turmoil with global equities and the PSEI shoved into turmoil along with Asian equities as well. So these are down by about 30% on a year-to-date basis. So I guess just to get it out of the way, the Philippines faces a recession in the first half of 2020. If you look at the GDP, Philippine GDP or gross domestic product estimates, it's actually all over the place. you have relatively more pessimistic forecasts from economists of about -1 to -2% on one hand. On the other hand, you have those economists which are still looking at above 5% growth. So where exactly should we anchor our investment thesis on? And our view with ATRAM is that GDP will likely slow down to about 2%, close to 2% in 2020 because of, well, the economy's proverbially grinding to a halt in the first half of 2020 because of the lockdown and the expanded lockdown and quarantine. And yeah, so, and safe to say that, well, growth will still be 2% this year in our view, and there will be a significant rebound, most likely in the fourth quarter of 2020. That's still our operating assumption at this point. And that said, I guess it's without saying that we think while the economy is grinding to a halt in the first half, the overall economy is not broken. I think one of the strategists described the Philippine economy as in the second quarter in particular as being in a state of suspended animation. So we're looking at a rebound in the fourth quarter, and we're looking at full year GDP growth to average about close to 2%. However, safe to say, because of the halt of economic activity in the first half, particularly the second quarter, sector earnings downgrades are actually inevitable. So in the next slide please. In the next slide, you see that we have actually downgraded our earnings growth estimate for companies in the market to about -3%. So we anticipate earnings, well, first of all, we anticipate GDP growth to slow down from 6% to around 2%. On the corporate earnings front, we anticipate the impact of the lockdown, COVID-19 and the implied lockdown and the commensurate lockdown to result to a downgrade in our overall earnings forecasts. We were originally looking at about plus 11% for corporate earnings for 2020. That's if you recall, coming off a record or a banner year for Philippine companies, because Philippine companies grew by about 11% in 2019, and that's pretty significant because over the past 5 to 7 years, the core earnings growth for companies in the market was only at about 5%. So banner year for 2019, led by significant industries, and our view was that given the resumption, given domestic demand, given accommodative monetary policy, and given the infrastructure spending program, that earnings growth momentum from 2019 would actually carry over into 2020. But obviously, you had the Taal volcano eruption disruption, and then now you have the lockdown in the first half of 2020 impacting the economy, and thus suggesting certain industries or most of the industries in the market would be hit because of the halt in economic activity. And our view that earnings will contract by about 3% this year. In terms of specific impact on corporate earnings, we believe that infrastructure and industrials, which include aviation companies and related names, will face significant reduction in air traffic. We anticipate slower trade volume growth from supply chain disruptions and construction delays in large-scale infrastructure projects. So infrastructure will be slowing down significantly this year. We also anticipate banks to be hit by the lockdown. We anticipate the economic disruption to result in an uptick in consumer and SME NPLs or non-performing loans. So, and credit costs probably could go higher, and of course, loan growth could be slower for 2020. That's our view. Real estate, likewise. For real estate, we anticipate retail and hotel and resort segments, or basically accommodations, to be most affected, while residential sales could likewise slow down and launches scaled back or even be canceled by some customers. So property would not be insulated. The biggest effect would probably be in gaming, wherein the base case is 2 months of lockdown. We believe, well, there's really one significant gaming company there, Bloom or Solaire, can go for about 5 months of suspended operations before incurring net losses. So that's their earnings threshold. Consumer discretionary would also be negatively or adversely affected, as they will be experiencing close to zero sales during the first, or at least the second quarter, perhaps, of the year. And even mining, base metal prices, nickel and copper, and ore volume sold will likely remain depressed. And this is because of obviously low global demand. Um, there are industries, specific industries, that will be relatively more neutral in terms of earnings downgrade risk, or will be less affected. Consumer staples, for one, we think will benefit from the surge in sales volume because of panic buying in the second quarter. I'm sure you've had your own experience of, or you've witnessed panic buying in the groceries, especially approaching the lockdown and even in the early stages of the lockdown. We think spending, though, will normalize in the second half of 2020, but obviously buying will be significantly front-loaded. Costs may rise from supply chain disruptions, however. That's on the retail, on consumer staples. We think consumer staples will actually be a net beneficiary of the current state of affairs. Telecommunications companies will actually be neutral in terms of earnings impact. Actually, we believe will be a slight beneficiary of the situation, as they experience upside from the increase in fixed line broadband revenues and data volume from people working from home. The third telco player likewise now may face significant delays because of the situation as well. Power and utilities, while we anticipate demand from Luzon, the power demand in Luzon to have declined 30% during the lockdown, power generation companies with relatively higher exposure to the wholesale electricity spot market may see lower than expected power sales. So that's that. Next slide, please. Because of these uncertainties and because of the downgrades and potential downgrades in terms of earnings and in terms of the economy, again, we're looking at a 3% contraction in earnings for 2020. But if you assume a longer lockdown, we're looking at an impact of probably closer to minus 10% rather than just minus 3%. So that's that. The Philippine stock market has been hammered down to or even lower than 2009 levels, and this is significant because 2008 was the worst period or the worst financial crisis in stock market history, and we're at those levels already. So earlier in the slide we showed the price earnings ratio, which is essentially the price over earnings per share, or the price you pay for every peso of earnings. And the general rule here is, of course, the higher the price earnings ratio is, the more expensive the market is, and the lower it is, the cheaper the market is. And we have been hammered down. The PSEI has been hammered down to crisis levels, or the worst financial crisis-like levels. More importantly, while the price earnings ratio is very important and is used universally by investors, whenever we have big swings in the market like this, we revert to what is called the Buffett ratio, or the market cap to GDP, because while the use of PE, as what is shown in your slide shows, is important and very simple and is universally accepted, it also has distortions that are not taken out. So items such as earnings dilution, non-recurring income or losses, So so we think a more reliable gauge of looking at market valuations during times of crisis is the market cap to GDP ratio, or the Buffett ratio, or the Warren Buffett ratio, um, as popularly known as the Buffett ratio. So here, this is essentially just the market cap of companies in the PSEI divided by the GDP of the Philippines. And the chart shows now affirms that we are at crisis levels. Chart shows that we have actually, at some point during the fall in the market, breached 60%. And 60% is significant because um, the market, the last time the PSEI went down to and actually went lower than 60% was during the 2008 financial crisis, or the global credit crunch. That's significant because that was the worst financial crisis in history, in worst global financial crisis in history. And we have reached those levels, although, like I mentioned earlier, the market has bounced a little bit. So um, we've experienced a few good days in the market, and that's why the market is at or slightly above 60% market cap to GDP. So does the PSEI deserve to be at these levels? We understand why we're at these levels. I mean, the market is essentially showing you not just the information that's available in the market, but the prices also show you right now in the stock market the prevailing or pervading fear in the market, or the emotion in the market. And a lot of people are selling regardless of valuations. They're not looking at fundamentals, and that's I guess from being in the market for 26 years, that's what we've learned, that during periods of crisis, there tends to be people throwing out the fundamentals, and that's why markets go to very, very cheap levels. And right now we are at level at which we were at the last time we had a global financial crisis. So putting things into, so our thinking is the best way to be able to cope and manage with the situation is to maintain is to get as much information and perspective as possible. So the first question we ask ourselves is the economy broken, and do we deserve to trade at crisis-like levels? Our answer is no. First of all, there have been significant improvements in the Philippine economy compared to 2009 when we were last at these levels. So in the next slide. So that's the Philippine economy in 2009 versus today. So we'll see that the S&P credit rating of the Philippines has actually improved today to BBB plus from BB minus or BB negative in 2009. So big improvement. We are now actually a notch below S&P A credit rating. Second is GDP per capita of the Philippines has actually increased significantly to almost $8,000 from 5,300 roughly in 2009. So consuming power has increased. Government to GDP has likewise dropped. It improved to about 42% from 55% in 2009. And I think very importantly also, the gross international reserves, or the GIR. The GIR for the Philippines has actually doubled to about 88 billion US dollars compared to dollar reserves of the Philippines of about $44 billion back in 2009. So that's a doubling of your capacity to fund imports, and your dollar reserves actually doubled. In the next slide please, we talk about that a little more. So what's significant here is that not only have the Philippines dollar reserves doubled since 2009 when we were last at these price levels for stocks, but the GIR of the Philippines, the dollar reserves of the Philippines, is actually not just doubled compared to 2009, but actually higher now compared to our external debt position. In the past, well, in 2009 and prior to that, the Philippines has always had dollar reserves below the external debt position of the country, and that's a very important point. So now, the dollar reserves of the Philippines has actually not just doubled, but it's actually above the external debt position, and that just affirms the strength of the Philippine economy. It's another testament to the strength of the Philippine economy, that the Philippine economy is pausing at this point, is experiencing a pause, but is definitely not broken, and the long-term prospects remain positive. Financial health is definitely as strong as ever. Corporate buybacks are ongoing in the market, and this is a list of companies that have reported corporate buyback programs and are reporting corporate buyback activities. So that's a testament that the listed companies are actually putting their money where their mouth is. They believe that the long-term prospects are still quite positive. So that said, lessons from past crises. We think that when every crisis is different and unique, there are commonalities, like how market phases pan out. Market phases meaning how investors react to crisis. And now we're seeing indiscriminate selling in the market, which is indicative of panic, and then panic selling. So again, lessons from 26 years in the market is you want to look for periods of peak panic, because after you experience the peak panic, there is usually stability in the market that follows as sentiment eases, and then it's followed by at least significant crisis like and downturns in the market like this has over at least the past 20 years been followed by a period of steep recoveries. So we're not saying it's going to definitely be a steep recovery, but given that the economy is still very strong, and the industries and companies are strong, we believe that we will survive all of this, especially assuming on a base case that the lockdown does not exceed 3 months. We're, I think, on day 25 or day 24 of the lockdown, and our thinking is that the situation in the economy will become progressively worse if this is extended to about 3 months. Our base case is that peak panic in the market will or may occur over the next 4 to 8 weeks. And the factors to look at: number one, COVID-19 daily infection rates peak. Number two, global manufacturing indices hit troughs or have bottomed out. Number three, there's clear-cut fiscal easing, and we're seeing this already in the Philippines. In the Philippines, stimulus and easing measures have been announced and have been are ongoing. On the monetary side, we had a 75 basis point cut in the the BSP cut interest rates by 75 basis points, bringing, I think, year to date by about 75 basis points. Sorry, and then you also had a 200 basis point cut in the reserve requirement, and we had a 300 billion peso budget also for government security purchases and additional relief for the banks, if I'm not mistaken. On the fiscal side, we had, I think we heard about $500 billion being announced spending package for the DOH and for select industries that will be affected significantly. And realignment of the budget towards COVID-19 response measures. So that, in our view, is significant. So as we see the peak panic over the next 4 or maybe even up to 8 weeks, we think that that will signal the bottom in the market. That's my view. But just to make it clear, things could get progressively worse. Things could get worse, not progressively worse, as we increase testing. I think mass testing will start mid-April, and but we think that the economy will rebound and recover on the back of in the second half, maybe most likely the fourth quarter of 2020, on the back of a recovery in domestic demand, on the back of a continuation of accommodative policy and resumption of the massive government infrastructure spending program. On top of that, we also see structural improvements in place. More specifically, we believe that late this year or next year, we're going to see a significant cut in the corporate income tax rate, up to a 500 basis point cut in the corporate income tax rate, and that will be embraced by investors. We're also looking at the positive effect of lifting of foreign ownership on Philippine companies. And of course, the real estate investment trust law, which I think Ayala Land was scheduled to come out with the first Philippine REIT, and we think that will revolutionize the real estate industry or the property market, and that should be good for the market in general. And the strategy is essentially to position for quality. We think that it's very rare that you see BPI, for example, trading at 0.8, 0.9 times book value or below book value. A lot of index names, high quality names, offering significant upside based on current levels. And honestly, I never thought I'd see these stocks at these levels again, but surprise, they are. And the strategy is it's really to buy into the best of breed index names at this point, because there's less impetus to buy companies that are smaller. If you can buy the large growing companies at very cheap levels, there's always room for a strategy, of course, to invest in smaller companies. But you would need to limit yourself to companies with very strong balance sheets at this point. So that's the strategy for the equity opportunity fund of ATRAM. We're buying into best of breed companies, and we've reduced our non-index names. So in the next slide. So the next slide shows you essentially the strategy. We are positioning for 2021. We think the market has dropped to levels to crisis-like, very inexpensive levels, and there is a lot of value in the market today. It's very interesting because it's like you're attending a sale. People like buying toothpaste. People are happy buying toothpaste at 20% off. They're already happy when they can buy toothpaste at 20% off. If you could buy an iPhone perhaps at 30% off, I think you'd be very happy. And the drop in the market shows that you're actually buying the PSEI today at a 30% discount to where it was start of the year. More importantly, you can buy, if you consider cell phones as an investment, I mean, you can actually, in actual investment terms, the slide shows that high quality, best of breed companies are actually trading at massive discounts to intrinsic value. Jollibee, your upside is 80%. SM Prime, your upside is 79%. I mean, of course, this is for long-term investors. If you are a short-term trader or short-term investor, I don't think being in the market at this point is the best advice, unless you have psychic abilities. But it's very hard to get the bottom of the market. And those are things, the indiscriminate selling, the panic, those are things out of our control. What we have control over is the fact that is our analysis. Looking at the intrinsic value of companies, given downgraded earnings assumptions already, we see 80% upside in Jollibee, for example, and SM Prime, 70% upside in Ayala Corp, almost 70% upside in Ayala Land. BDO is trading at a discount. BPI is trading below book value. You have Wilcon, PLDT, SM trading at massive discounts to intrinsic value. We haven't seen since the past crisis. So in January, we employed a strategy as early as January, actually, before things started to tumble already significantly. We started employing for the Equity Opportunity Fund, a strategy of reducing non-index names because we were seeing greater value emerge from companies such as Jollibee, SM Prime, Ayala Land, and so on and so forth. And we were reducing non-index names because we were seeing great value in these companies in the blue chips. So we were reallocating funds after reducing the non-index. We were allocating into the blue chips, deploying funds selectively into the blue chips. We're maintaining cash at about 10%, but we're um, deploying what we've been selling into the best of breed blue chips. Um, our criteria is, and just to be clear, we're not redeploying into selective names just because they are blue chips. We have a basis for that. We're looking at companies with, number one, strong balance sheets. Number two, companies with the ability to bounce back from this crisis strong and maybe even stronger, which intuitively is because their competition is weaker. And third, we're looking at companies that actually are performing responsibly during this period of crisis. And this is more ESG, or environmental, social, governance related. It's more of, we like companies that actually are treating their employees right uh, during this period wherein their employees need them the most. Companies who are paying their employees in full, and companies that are not really destroying the environment. Know that. So that's the general strategy. As mentioned earlier, we are maintaining cash levels of about 10%, until we see significant signs that the market has bottomed. Again, by bottom, we mean the signs we're looking at are COVID-19 daily infection rates peak, and start going down. Global manufacturing PMIs are rebounding already. Clear-cut fiscal easing, which is already happening. Or if a vaccine is actually announced already, that will probably mean market is bottomed. Yeah, so the last slide is the Equity Opportunity Fund, and it shows how the fund is positioned. Again, best of breed names: SM, SM Prime, um, BDO, BPI, Ayala Corp, TEL, and it's not investing in the entire index is the point, but very selectively and with very intentional specific weights in mind. Mm, with regard to the small and mid cap strategy, Alpha Opportunity, um, at the fund is underperforming the index, the PSEI, but if I remember correctly, it's actually outperforming the small cap index by about 400 or 500 basis points, and that's because it doesn't invest in all small caps, very selective also. But the underperformance against a benchmark is because small caps, even in as early as late last year, I think in the fourth quarter, there was a meaningful underperformance of Alpha Opportunity. And that's because the small cap index underperformed as investors were buying into large caps late last year and up to the start in January this year. So that's the reason the fund was underperforming. Um, right now, the composition of the Alpha Opportunity Fund is a reflection of the strategy of the Equity Opportunity Fund, which is to invest in best of breed, but in this particular case, smaller companies with very strong balance sheets. And we're talking about companies. I think the biggest holding of Alpha Opportunity now is one of the biggest beneficiaries of this lockdown, Pure Gold. It's invested in Wilcon, First Gen, Security Bank, high quality bank, 7-Eleven, which has a lot of stores open during this, even during the lockdown, and dominates the retail space. Defensive qualities in Manila Water, having bought Manila Water when after it it plunged significantly. And yeah, companies like EI and Pizza are still there. So yeah, so that's it in a nutshell. Happy to take your questions.
Thank you, June. Indeed, it's during these times that we find value in professional fund managers. When overwhelmed with uncertainty, we, the regular investors, usually just freeze up, not knowing what to do. So I'm sure that those of you who were in panic mode have found some level of comfort knowing that we just have to wait for the peak before we can start to recover. Hopefully, as June said, by fourth quarter of 2020. Position for quality. That was the key message for me. Thank you also, June, for sharing your data with our audience.
Most welcome.
Okay, thanks again, June. I'm sure our viewers were able to gain insights on how they can improve their respective investing strategies despite this global crisis. So before we proceed with our Q&A, we would like to remind everyone that you can still send in your questions about our topic for today through the Q&A option on your screens. We will be entertaining them in a bit. Joining the discussion is the man behind First Metro Sec's monthly market wrap-up webinar series and is also the main author of Traders Playbook Research Reports, which aim to give out trading ideas on specific and relevant stocks. So please help me welcome our special guest for today's Q&A, our research associate, Mr. Royce Aguilar. Hello, Royce, and welcome.
Okay, hello, good afternoon.
Okay, now on to our Q&A. As we wait for questions from live viewers to start pouring in, maybe we could start with some questions which were sent via email. Okay, first question is from Albert Am. I think June may be the best person to answer this. The ECQ for Luzon has officially been extended until April 30. With this, what can be expected from the equities market in terms of reception to this news and timeline of subsequent recovery?
Well, we've since the announcement, the market has actually been holding steady, and I think that's also because the fact that they extended the ECQ. Although we need to get more data on what the guidelines for the extended quarantine will be, but the fact that it was extended by 2 weeks, they could have extended it another month, and the fact that it was extended only 2 weeks despite cases, infection rates not easing yet, suggests that it's probably going to take a lot for the quarantine to be extended to 3 months, which is when things get progressively worse, meaning the economy will be significantly impaired and banks will have problems, and et cetera, et cetera. But I think that suggests also that we're still within the base case of 4 to 8 weeks before we see 4 to 8 weeks of continuation of the status quo before things probably normalize. So that said, the fact that the markets are actually holding steady is probably a sign that because the extension was only 2 weeks, it kind of puts perspective that maybe a 3 month lockdown is probably less likely at this point. Although we again recognize the fact that mass testing will probably result to a significant increase in the numbers, infection rates soon. But yeah, did I answer your question?
I think well enough. Thank you, June. Here's a question for Royce. As someone in research, what things have you gotten right and what things have you gotten wrong during this crisis? For the wrong ones, any way to correct them?
Well, I think in terms of what we were right on, I think at the start of the year, we were already positive on consumer names. Of course, some of those names, the likes of your CRHI, Pure Gold, have also corrected. But compared to the other index names, actually, when you take a look at Pure Gold as of yesterday, it's actually up a bit year to date. So I think that's what we have been really positive on since the start of the year. So that's probably what we're right on. What we maybe have not seen, of course, no one has really seen this pandemic coming. But I think what we told clients also was to really invest on cyclical names at the start of the year. So of course, what is notable as of the moment, defensive names are outperforming the likes of telcos, the likes of Meralco, and the like. So of course, to correct them, to be honest, based on our own research, if you are a long-term investor, and I think cyclical always outperforms the defensive if we're talking about 3, 5 years, 10 years. So to be honest, while cyclicals are underperforming as of the moment, if you're a long-term investor, picking up cyclicals as of the moment, just like what June mentioned earlier, you're gonna see some cyclical names there. Also, you can hedge your risk by investing in some defensive names. But overall, investing in um, cyclical names which has intrinsic value that malaki yung value moving forward, that's the way to go. So we agree. In our part, we're positive also on the likes of SM. We're also positive on BDO, SMP, HL, So
Okay.
there.
Okay. A question from Brian Eugenio. What are the advantages and disadvantages of investing in mutual funds compared to direct investing in stocks during times of crisis? June?
Well, mutual funds, the advantage is that your fund, instead of having to do your research on your positions, if you were
Yeah.
assuming you were invested in stocks already and you get hit, because I'm answering this in the context of you're already invested or you're investing during times of crisis, right? Tama ba, Van?
Yeah.
Is that
Yes.
correct? So
Like now.
the advantage of having a professional fund manager is, number one, that's what we do. That's our job. And number two, we have access to uh, several a multitude of research sources, which include the actual listed companies um, we invest in and even don't invest in, industry experts who give us, I think, very reliable information on the different stocks, um, uh, government sources. We also talk to competition of these companies. We talk to suppliers, distributors. In other words, it's a very holistic network of industry sources that is funneled into our research team, which gives us, I would think, very good perspective in terms of making investment decisions for you as the investors. I don't think you would an ordinary investor, individual investor, would ordinarily have that network of information at their fingertips for them,
Yes.
and plus they have to make informed decisions on buying and selling stocks. So all of that is processed and is and culminates in an investment portfolio we construct specifically for you to weather whatever situation or prevailing market situation or conditions are.
So related to that, June, another question from Ron Somera. What investments can ATRAM recommend for near to midterm tenure with better returns but low risk and for capital preservation? So she's open to both US and peso denominated investments. What could
I'll
be
leave.
good?
I'll throw this question to Andrew because Andrew handles the entire channel, so he would have the spiel there. Andrew, you wanna answer that? Andrew Kao.
Hi, good morning, good afternoon, everyone. Um, Van, can you repeat the question? I didn't quite get that.
What could be good ATRAM funds in the near to midterm? Like June said, for short-term traders, maybe you need psychic abilities to be good in this kind of situation. But for those who are into fund investing, what could be good ATRAM funds to get into now?
Right.
Midterm.
That's actually, thank you, Van, for that. That's a very good question. For times like this, definitely we strongly suggest as well. Of course, we have a diversified range of funds. We have fixed income funds. We have as well these balance funds as well that gives you this really the best of both worlds. That if you're not too sure that you want to really put all your money into really to equities, there's still basically options as well to have your portfolio really diversified as under the balanced portfolio, which is why we have a balanced fund. One thing that First Metro has that I guess that doesn't no one else has in terms of our distribution is really the dollar bond funds, the total return dollar bond funds. Wherein definitely is doing very well. Times like this, fixed income portfolios are doing very well as well. So something that we should also have a little bit of diversified story as well into that. So it's really where you currently are is situated in your portfolio. If you're already heavily invested in equities, maybe you want to diversify a little bit in terms of fixed income funds, as well as if you're purely invested in blue chips, like June mentioned, and like Royce mentioned in terms of their views. You might want to also like diversify into small to mid cap securities assets. So that's basically your growth story. That when markets do more or less bounce back, that those are the first types of growth type of stocks that will really recover fast initially and or faster. So there's a diversified type of funds that we have. So again, balance funds, our total return dollar bond fund as well could be something that one should be looking into as well.
So this is really the time where you appreciate being diversified in your portfolio.
Definitely.
Okay, thanks for that, Andrew. Another question, June already mentioned this during his presentation, so maybe we should ask Royce what his view on this is. So did we already reach the bottom, which was around 4,000? Are there signs that the market will likely crash again? Royce, what do you think?
Well, I think again, it's really hard to know where the bottom is. But I think what is good to mention that every time the market goes down, the risk to reward is increasingly skewed to the upside. So if you are a long-term investor, definitely every time the market goes down is an opportunity. Again, no, if you're a short-term trader, it's another story. Of course, if you're a short-term trader, you should follow your technicals, you should follow your rules, your cut loss, when you will take profit and the like. But if you're a long-term investor, every time the market pulls back, especially as of this moment, is an opportunity to buy. But of course, you have to be selective. So that's why I agree also with Jun there that you have to pick good names. So of course, besides select blue chips, you're also positive, like I said, on consumer and the like. So those are companies that are resilient. And once the dust settles, those are the stocks that will outperform. So it has been proven, and given their continued expansion all over the years, they will continue to outperform. So
Bentan would like to ask, Royce, is the market still in consolidation phase?
yeah. Well, to be honest, I don't really see the market consolidating as of the moment. So that brings me to my next point. So the market may pull back because I think this recent rally may be a bit too sharp. So this actually provides opportunities for both short or long-term investors to actually pick up stocks in the next few weeks should it correct, because we think the recent rally may be too sharp. So maybe moving as the market pulls back, some investors will digest the possible economic impact of this pandemic. But nevertheless, again, no, every time it pulls back, risk to reward is skewed to the upside. So it's an opportunity rather than a way to be for us to fear about it. It's an opportunity. So.
Okay, we have a lot of questions pouring in, but unfortunately we have limited time left. So maybe for the last question, maybe both of you can
Van?
give one.
Hi,
Yes,
Van. Can I just add to what Royce mentioned? I think
sure.
you did it very well. Just wanted to ask you to go back to the slide on Philippines in 2009 versus now. Can you go to that slide, please? So okay. So the market, the movement in the PSEI is showing you that that there is something really wrong in the economy. That's what the PSEI levels are telling you right now, and 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 that is mainly showing you the fear in the market right now. So we go to this slide because this slide gives you a sneak peek, and this gives you insights that the Philippine economy is not broken, and that there have been meaningful improvements in the Philippine economy today compared to where we were as an economy back in 2009. What we are experiencing right now is a pause in the economy. It's not broken. So, what will change that? Because the question is, have we seen the bottom already? If, as we mentioned earlier, we think as long as the lockdown, well, a 3 month or so lockdown will mean the economy, things get progressively worse for the economy. Meaning, right now we can still rebound in the second half, but it will be complicated if the lockdown is extended past 3 months. That said, unless that happens, uh, you are. Can we go to the slide now? In terms of strategy, positioning for 2021. So I guess the point is, if the lockdown is 2 months only, you are buying Jollibee, SM Prime at an 80% discount, or the upside is 80% roughly, and a number of other blue chips at very inexpensive levels. You're buying the market are at least a 30% discount. So that's how we look at it. 2021 should be better unless there is a lockdown more than 3 months.
So since you mentioned that, June, how do you see the market 12 to 18 months from now? At what level, possibly?
I wouldn't be surprised if we're at least at start of 2020 index, which is what, 7,000 something. I wouldn't be surprised because the difference between today and back in 2009 is events get priced in much faster. I think we saw more than a 30% drop in the market in March. The biggest drop, I think, in 20 at some point we were more than 40% down. I think the worst drop in 2009 was on a monthly basis was, I think, at or close to 30%. So because of the current conditions, events are priced in much quicker, and events being priced in much quicker on the downside can also be priced in much quicker when things improve on the upside. So we're not discounting the possibility of a V-shaped recovery in the Philippine stock market. This is very important, I think, because as I mentioned, over the past few days, the market's up already by 20%. And we think things will get worse, at least from an information standpoint, as they do mass testing. Okay, fine. But the selling has been excessive relative to the fundamentals of the economy, relative to the fundamentals of companies in the economy. I think if we were to be more conservative, I mentioned earlier, our research team is anticipating a 3% contraction in earnings this year. Anticipate 10% contraction in earnings. So more than double the what we're getting in terms of our numbers, showing a negative 10% contraction in earnings. The market shouldn't have dropped by 40%. So I guess what I'm saying is, if you look at 2021 and you're happy, if you're one of those consumers who are happy buying toothpaste at a 30% discount, or an iPhone, happy to buy an iPhone or a Samsung S10 probably at a 40% discount, I think you will be rewarded buying companies and funds that are investing in these companies at current levels. assuming a base case scenario of a lockdown not exceeding 3 months. That's our.
Okay. Thanks for that, June. Unfortunately, that's all the time we have for now. But no worries because we will be scheduling more webinars like this in the coming week. So also to ease your boredom at home, guys. So hang on to your questions and we'll have our speakers shine light on them on the next discussions. I hope that we were able to provide a little more clarity through this Q&A. Our sincerest apologies that we weren't able to entertain them all due to the limited time, but our heartfelt thanks to all of you who stuck with us up to the end. Thank you, of course, to our speaker, June, and our guest panelist, Royce, for answering the
Thanks for
questions
having us.
of our viewers. Thanks. And before we bid you bye, however, just a quick last plug. Please do follow us, like us, and subscribe to our social media channels, Facebook, Instagram, Twitter, and YouTube to stay up to date with the market and be notified of our online events like this one. We will also be uploading this webinar on our YouTube channel, so please watch out for that. Again, don't forget to like ATR Asset Management on Facebook to get first dibs on their updates. Once again, thank you very much to everyone who tuned in for today's online outlook with ATRAM. We hope that you found the session worthwhile, and of course, we wish you the best in your investment journey. This has been your host, Vanessa Galvez from First Metro Sec, along with our speakers this afternoon, Jun Tarrobago from ATR Asset Management and Royce Aguilar from First Metro Sec. As always, with First Metro Securities, it's hashtag your future first. Bye, everyone. Stay safe, stay indoors, and stay healthy. Have a good afternoon.
Thank you.
You.
Yeah.